Hi, this is Bob Gersh with East Coast Capital, and today's topic is explaining today's mortgage rates. Explaining today's mortgage rates. If you're following mortgage rates because you know they impact your borrowing costs, you may be wondering what the future holds for them. Unfortunately, there's no easy way to answer that question because mortgage rates are notoriously hard to forecast. But there's one thing that historically a good indicator of what's happening with rates, and that's the relationship between the 30-year mortgage rate and the 10-year Treasury yield. On my blog at askbobgersh.com, I posted a graph showing those two metrics since Freddie Mac started keeping mortgage rate records in 1972. As the graph shows, historically, the average spread between the two over the last 50 years was 1.72 percentage points, also commonly referred to as 172 basis points. If you look at the trend line, you can see when the Treasury yields trend up, mortgage rates usually respond. And when the yields drop, mortgage rates tend to follow. While they typically move in sync like this, the gap between the two has remained about 1.72 percentage points for quite some time. But what's crucial to notice is that spread is widening far beyond the normal lately, as depicted on the graph. If you're asking yourself, what's pushing the spread beyond its typical average? It's primarily because of uncertainty in the financial markets. Factors such as inflation, other economic drivers, and the policy and decisions from the Federal Reserve are all influencing mortgage rates and a widening spread. What does this matter for you? This may feel overly technical and granular, but here's why home buyers like you should understand the spread. It means based on the normal historic gap between the two, there's room for mortgage rates to improve today. And experts think that's what lies ahead as long as inflation continues to cool. As Odetta Cushy, Deputy Chief Economist at First American, explains, it's reasonable to assume that the spread and therefore the mortgage rates will retreat in the second half of the year if the Fed takes its foot off the monetary tightening pedal. However, it's unlikely that the spread will return to its historic average of 170 basis points, as some risks are here to stay. Similarly, an article from Forbes says, though housing market watchers expect mortgage rates to remain elevated amid ongoing economic uncertainty and Federal Reserve's rate hiking war on inflation, they believe rates peaked last fall and will decline to some degree later this year, barring any unforeseen surprises. The bottom line, if you're either a first-time home buyer or a current homeowner thinking of moving into a home that better fits your current needs, keep on top of what's happening with mortgage rates and what experts think will happen in the coming months. This is Bob Gersh with East Coast Capital with this blog, video, and podcast Monday through Friday at askbobgersh.com. If you'd like to connect with me or any questions, please go to askbobgersh.com. Have a great day, a great rest of the week. If you do see me in the local coffee shop, tap me in the shoulder. Let's sit down, have coffee, and talk about whatever you'd like to talk about. Until next time, thank you.